Lisa Erickson, head of the public markets group at U.S. Bank Wealth Management. And I do mean that, Lisa. I do mean markets, because I could be talking about the gold market, or I could be talking about fixed income, which is the 10-year hit 4.19. But usually we are talking about the equities markets. And what does all this mean for the S&P for the rest of the year and for next year, in your view?
Well, Joe, right now we have a balanced view on the U.S. equity market. And the reason why is when we look at the balance of rewards and risks, we really see them as fairly equally weighted. So on the positive side, you've really had a lot of resilience, obviously, in the consumer and the labor market. But certainly on the con side, we have had fairly restrictive policy, and those rate increases come through with a lag. And it's not clear that the Fed is done. On top of the fact that we've had some positive progress on inflation, but again, we're not back to that 2% target. So our best advice to clients right now is really to stay neutral to whatever their typical strategic weights would be, as opposed to really trying to over or underweight.
The Fed might not be done, Lisa. That goes against, I think, what a lot of market players are counting on at this point.
Well, certainly the Fed is closer to pausing and pivoting than they were at the beginning of this cycle. We just look at the fact that it's just not exactly clear when that's going to happen. And so, again, there's some uncertainty as far as, when those easing conditions might actually start. And on top of that, you've got pretty aggressive rate cut expectations in by the market. So there's really a little bit of a risk where the market is really anticipating, even as early as March of next year, that the Fed could really start cutting. And again, it's just not clear, since they are very committed to that inflation front, exactly how quickly they're going to move.
If you were a betting person, Lisa, the first rate cut comes next year in 2024. Definitely there will be a rate cut. Even that is a position that isn't, necessarily a slam dunk. But if we do get one, when do you expect it? What quarter?
Well, certainly it's hard to, again, in our view, predict the timing, which is really why we're at this more neutral position in terms of our U.S. equity bet. Certainly, the data would indicate that you've got some really nice price pressure decreases, as well as the fact that, growth is, again, in that kind of middle of the road scenario. So the Fed is not necessarily having to react either way to that as well. So certainly next year does look at likely possibility. But again, the exact timing is up in the air. So
the last time that we saw all the companies report, which was just in the last couple of weeks, what did they say, or with their comments about the next quarter or next year? Will estimates have to come down for most U.S. companies?
So we do have pretty aggressive growth estimates for 2024. I think they're running around 10% right now, which, again, really is a very optimistic scenario. And while companies certainly have been very resilient and good about keeping their profitability up, we are concerned that those estimates might be somewhat on the aggressive side. And so, we are watching the direction of those estimates. Again, we haven't seen a lot of movement. They've stayed pretty steady over the last couple of months. But we do know that as we went through the third quarter reporting season, the companies really were pretty guarded and not offering a lot of guidance. So that is a note of caution.
Okay, we're going to have to end it there. Lisa, a lot of people talking about balanced approaches to things now. I guess balance is always a good thing.